Welcome back to the deep dive. Really glad you could join us. Today, we're tackling something that, well, it trips a lot of people up. We're diving into the sometimes confusing world of Social Security benefit taxation. The big question, is it taxable? And the answer, maybe surprisingly, is well, it depends. And what it depends on, mostly, is this thing called modified adjusted gross income, or sometimes provisional adjusted gross income. We're going to unpack that. But before we dive deeper, just a quick reminder, this deep dive is based on material from Farhat lectures. All the content, the examples, everything we discuss here, it's derived from the resources over at farhatlectures.com. So whether you're an accounting student studying for the CPA exam or already a professional, you should definitely check out the website. They've got extra practice questions, video lectures, tons of support to help reinforce what we're talking about today. And a special thanks to Professor Farhat for providing all this great material. Okay, so let's kick things off. This idea that Social Security is tax-free, it's pretty common, right? But not quite the whole story.
No, not at all. It's a very common misconception, actually. Whether your benefits get taxed isn't just a simple yes or no. It really hinges on two main things. First, like you said, your modified adjusted gross income, MGI, or provisional income, same idea. And second, your tax filing status. Those two work together. The good news is the system is sort of designed to help out lower income folks. So if you're generally in a lower individual tax bracket, chances are pretty good that none, zero, of your Social Security benefits will be taxed.
Okay, so there is an exemption for lower incomes. That's important.
Definitely.
Oh.
But the range, it's wide. It can go from 0%, completely tax-free, all the way up to 85% of your benefits potentially being taxable income.
Wow, 85%. That's
Yeah.
that's a massive difference. It really highlights why understanding this is so critical. So if everything rides on this MGI, this modified adjusted gross income, how do we figure that out? That seems like step one.
Absolutely. It's the foundation. So to get your NGI, you start with your AGI adjusted gross income. That's your gross income after certain deductions, things like traditional IRA contributions, student loan interest maybe. It's your income before you even think about Social Security.
Okay, AGI. Got it. Starting point.
Right. Then you have to add back some specific things. Items that might normally be excluded or deducted from income, but not for this calculation. And what's interesting is why they make you add these back. It's about getting a clearer picture of your actual financial resources.
Ah, okay. So what kind of things are we adding back?
Things like interest from U.S. savings bonds if you excluded it for education costs. Also, most tax-exempt interest, think municipal bonds, and that's a big one.
Wait, so even if my muni bond interest isn't normally taxed, it could make my Social Security taxable.
Exactly. That catches people by surprise. The idea is to stop people from, say, loading up on tax-exempt bonds just to lower their AGI and then get their Social Security tax-free too.
I see. It levels the playing field, in a way.
Sort of, yeah. Other add-backs include employer-provided adoption benefits, certain foreign income you excluded. Also, deducted interest on educational loans that gets added back here, and deductions for tuition and fees.
Okay, quite a list.
And then the really crucial part, you add 50%, half of the Social Security benefits you received during the year.
50% of the benefits themselves get
Yes.
added into this provisional income calculation.
That's right. All those pieces together give you your modified adjusted gross income for figuring out Social Security taxability.
Okay, that explanation of the why behind the add backs is super helpful. It's not arbitrary. It's about that truer economic picture, like you said. So we've done the math. We have our MGI number. Now what? How does that number tell us how much tax we pay? Let's start with folks who are married filing jointly.
Right. For married couples filing jointly, it works in 3 tiers based on that provisional income number. Tier 1, if your provisional income is below $32,000.
$32,000. Okay.
If you're under that, good news. 0% of your Social Security is taxable. Completely exempt.
Simple enough for the first tier. What's next?
Tier 2 is if your provisional income falls between $32,000 and $44,000.
Okay, the middle ground.
Here, it gets a bit more complicated. The amount of your benefit that's taxable is the lesser of two things. It's either 50% of your total Social Security benefit or R, 50% of the amount that your provisional income exceeds that $32,000 threshold.
Lesser of. Okay, so you calculate both ways and pick the smaller number. That limits the tax hit.
Precisely. It caps the taxability in this tier, essentially making sure no more than half your benefit is taxed.
And then the third tier, for income above $44,000.
Right. If your provisional income is over $44,000, you're in the highest tier. Here, the taxable portion is, again, the lesser of two amounts. First option, 85% of your total Social Security benefit. Second option, it's a more complex formula. It's basically 85% of your income over the $44,000 threshold. PLUS another amount. That other amount is the lesser of $6,000 or 50% of your benefit.
Okay, that second part sounds involved.
It is. Honestly, the exact math there, you'd want to look it up or use software. We can link to the details. But the key takeaway is once your income gets significantly high, a much larger chunk, up to that 85% cap of your Social Security, can become taxable.
Got it. So the higher the income, the more likely you are to hit that 85% calculation, or at least a higher percentage. Now, that naturally leads to asking, are these thresholds, the $32,000 and $44,000, the same for everyone, like single filers?
Great question. No, they're different. The structure's the same. The 3 tiers, the lesser of rules that Logic holds. But the actual dollar thresholds change if you're filing as single head of household or qualifying widower.
Okay, so what are the numbers for those statuses?
For those filers, the first tier is provisional income below $25,000. Under that, zero tax.
$25,000 instead of $32,000.
Lower threshold.
Exactly. The second tier is between $25,000 and $34,000. In this range, same logic. Taxable amount is the lesser of 50% of your SS benefit or are 50% of your provisional income over the $25,000 mark.
Okay, following the same pattern. And above $34,000. Above $34,000 puts you in the highest tier for these statuses. And again, it's the lesser of 85% of your Social Security benefit, or that more complex calculation, similar to the married filing jointly one, but adjusted slightly. For this group, the add-on piece in the complex formula involves $4,500 instead of $6,000.
Right, so the principle is the same, and just adjusted numbers. The core idea is income level dictates potential tax.
That's the essence of it. Understand the tiers and the NGI concept, and you're most of the way there.
I think seeing how these numbers play out in real situations would really help solidify this. Can we walk through a couple of examples? Maybe not every single calculation step, but the flow and the result.
Definitely. Examples make it much clearer. Let's take Robert and Cindy. They filed jointly. Their AGI before Social Security is $15,000. They got $8,000 in Social Security. And importantly, no weird add backs, just the basics.
Okay, low income, married filing jointly. First step is their provisional income.
Right. So $15,000 AGI plus. 50% of their $8,000 Social Security, which is $4,000. Add those up. $15,000 plus $4,000, $19,000. That's their provisional income.
And for married filing jointly, the first threshold was $32,000.
Correct, since $19,000 is way below $32,000.
Zero tax on their benefits.
Exactly. Simple case, fully exempt.
Perfect. Okay, let's try another. How about Karen? She's a qualifying widow.
Okay, Karen, she receives $7,000 in Social Security. She also has $19,000 in regular interest income. And here's a key part. She has $5,000 in non-taxable municipal bond interest.
Ah, there's that muni bond interest, that add back we talked about. Perfect example.
It really is. So for Karen's provisional income, we take her $19,000 interest income, add the $5,000 muni bond interest, and then add 50% of her $7,000 Social Security, which is $3,500.
Okay, $19,000 plus $5,000 plus $3,500. That's $27,500.
Correct. $27,500 is her provisional income. Now, for a qualifying widow, what were the thresholds?
$25,000 and $34,000.
So her $27,500 falls right in that middle tier, between $25K and $34K. This means we use the lesser of rule for the 50% tier.
Okay, so option one is 50% of her benefit. 50% of $7,000 is $3,500.
And option two is 50% of the excess income over the threshold. So 50% of $27,500, $25,000.
50% of $2,500, which is $1,250.
Right. So we compare $3,500 and $1,250. The lesser amount is
$1,250.
Exactly. So even though Karen got $7,000 in benefits, only $1,250 of it ends up being taxable income. That lesser of rule really helped her there.
That's a fantastic illustration of how that middle tier works and how the muni bonds played a role in pushing her into it, but the rule still limited the tax impact. Okay, let's do one more, maybe a higher income situation.
Sure. Let's look at C&M. They file jointly. They have quite a bit going on. $46,000 in interest and dividends, $31,000 in self-employment income, plus $10,000 from non-taxable municipal bonds, and they excluded $1,000 of student loan interest. Oh, and they received $9,000 in Social Security.
Okay, lots of pieces here. Let's build that provisional income number.
Right, start with the core income. $46,000 interest dividends, plus $31,000 self-employment. That's $77,000 now add backs.
Yeah.
$10,000 for the muni bonds, $1,000 for the student loan interest.
So $77K plus $10K plus $1K, that's $88,000 so far.
Correct. Final step, add 50% of their $9,000 Social Security, which is $4,500. So $88,000 plus $4,500 gives us a provisional income of $92,500.
$92,500. Okay, for married filing jointly, that's definitely over the $44,000 threshold. Top tier.
Way over. So now we're looking at the lesser of rule for the 85% tier. Option 1,
Yeah.
85% of their Social Security benefit, 85% of $9,000 is $7,650. Option 2 involves that more complex calculation. 85% of the income over $44,000 plus the lesser of $6,000 or 50% of their benefit, $4,500.
Let's break that down. Excess income is $92,500, which is $4,500. $44,000, so $125. So $41,225. So it's $4,500 plus $4,525.
Okay, so option 2 gives us a huge number, $45,725. Option 1 was $7,650.
So the lesser amount is clearly $7,650.
Meaning $7,650 of their $9,000 Social Security benefit is taxable,
Yeah.
which is, well, it's 85%.
Exactly. In this high-income case, they hit the maximum 85% taxability. Those add-backs, the muni bonds and student loan interest, definitely contributed to pushing the provisional income that high. That really drives home how all those different income sources, even ones you think are tax-free or deductible, can come back into play for this specific calculation. It's eye-opening.
It really is. And you asked earlier who gets surprised. Often it is those middle-income folks, maybe retired with a pension, some investments. Maybe they have those muni bonds, thinking they're totally tax-free. But then that interest helps push their provisional income over a threshold, and suddenly part of their Social Security is tax. It wasn't something they planned for.
Right. It underscores needing to look at the whole picture.
Absolutely. So if we try to tie this all together for you, the listener, especially if you're planning for retirement or maybe studying for an exam, the absolute key isn't necessarily memorizing $44,000 or $34,000 exactly. It's understanding the concept.
The 3 tiers.
Exactly. The 3 tiers. Zero taxability at low provisional incomes. Then a middle tier where up to 50% might be taxed, thanks to that lesser of rule. And then a high tier where up to 85% can be taxed. And maybe a little shortcut. If someone has very high income from various sources, it's a pretty safe bet that 85% of their Social Security will end up being taxable.
That makes sense. Focus on the structure, the concept of provisional income, including those add-backs, and the tiered system.
That's the core understanding you need.
And knowing these rules, it's not just about Social Security, is it? It gives you a better feel for how the tax system looks at income overall, how different things interact.
Completely. It shows how definitions matter, like how income for one purpose might be calculated differently than for another.
Well, this has been incredibly clarifying. We've navigated through what can seem like a really dense topic, the taxability of Social Security, and hopefully shown how that modified adjusted gross income is the real key. It's a perfect example of how something seemingly straightforward has layers beneath it. So here's something to think about as you continue your own explorations, whether it's finance, tax, or anything else complex. Consider how understanding the logic behind rules like these provisional income calculations, the why, empowers you more than just knowing the numbers. It helps you anticipate how different financial pieces might fit together. So what other maybe hidden connections or income inclusions might be out there affecting your overall financial or tax situation? Something to ponder. Thanks so much for joining us on this deep dive. We hope you found it valuable. Until next time, keep exploring and keep learning.